China just pulled nearly 800 tons of silver off the global market in 2 months, and almost nobody is talking about it. 790 tons in 60 days. Let that sink in for a second. Because this is not normal demand. This is not seasonal buying. And this is definitely not random. This is strategic. And if you understand what that means, you start to see why this story could be far bigger than it looks on the surface. Here is what we know. China imported 790 tons of silver in just the first 2 months of 2026. Nearly 500 tons of that came in February alone, the highest ever recorded for that month, according to Chinese customs data. At the exact same time, China is restricting silver exports through a licensing system that is expected to stay in place until at least 2027. So just think about that dynamic clearly. They are pulling massive amounts of silver into the country and making it harder for that silver to leave. That is not a coincidence. That is policy. And when a country starts controlling both sides of a commodity flow, imports and exports, you are no longer looking at a market. You are looking at strategy. Now here is where most people underestimate what is happening, because they treat silver like a passive asset, something that just sits in vaults, something that reacts to inflation or interest rates. But silver is not passive. It is critical infrastructure. It sits inside solar panels. It sits inside semiconductors. It sits inside energy systems, medical technology, communications networks, and advanced manufacturing. It is not just money. It is functionality. And in a world that is becoming more electrified, more digital, and more energy dependent, silver demand is not optional. It is structural. So when a country like China starts aggressively accumulating physical silver while simultaneously restricting exports, the question is not, why are they buying? The real question is, what do they know that the rest of the market is ignoring? Because countries do not move physical commodities at this scale without a reason. They move early, they move quietly, and they move before the narrative catches up. Now let's break this down further, because the numbers alone do not tell the full story. 790 tons in 2 months is not just high, it is extreme. If that pace continues, you are looking at thousands of tons being absorbed annually. And remember, this is happening in a market that is already in deficit. Global silver supply has been struggling to keep up with demand for years. Mining output is not growing fast enough. Recycling is limited, and industrial consumption continues to rise. So what happens when one of the largest buyers in the world suddenly accelerates its purchases? The answer is simple. The rest of the world gets less. That is how supply tightening actually works. It is not always about production collapsing. Sometimes it is about distribution shifting. And when distribution shifts toward one dominant buyer, availability everywhere else shrinks. That is exactly what appears to be happening right now. Now add the export restrictions into the equation, because this is the part that turns a strong signal into something much more serious. China is not just buying silver, it is controlling the flow of silver. By restricting exports through licensing, it is effectively deciding how much of that metal can leave the country and when. That introduces a completely new variable into the market, because now supply is not just limited by production, it is limited by policy. And policy-driven supply constraints are far more unpredictable than natural ones. They can tighten suddenly, they can shift without warning, and they can create bottlenecks that ripple across global markets. This is where the term weaponized silver starts to make sense, because control over a critical resource is not just an economic advantage, it is a strategic one. And history has shown that countries use strategic resources to strengthen their position, especially in times of uncertainty. Now, to be clear, this does not mean there is some immediate crisis. It does not mean silver disappears overnight, but it does change the balance of power in the market, and markets are extremely sensitive to changes in power dynamics. Because once participants realize that supply is being concentrated, not just consumed, behavior starts to shift. Buyers become more aggressive, hoarding increases, speculation rises, and price begins to reflect not just current conditions, but future expectations. That is how commodities transition from stable to volatile. Now let's connect this back to the broader silver market, because this is not happening in isolation. At the same time that China is importing record amounts of silver, the global market is already dealing with a multi-year deficit. That means there is no excess supply sitting around waiting to absorb this demand. There is no cushion. There is no buffer. So when a large buyer steps in, the impact is amplified. And when that buyer also restricts exports, the impact becomes even more pronounced. This is how squeezes begin. Not with panic, not with headlines, but with quiet accumulation and tightening availability. At first, nobody notices. Then a few people notice. Then the market notices. And once the market notices, the reaction can be fast, because by that point, the physical reality has already changed. Now think about how this interacts with investor psychology, because silver is a market that thrives on narrative shifts. For long periods of time, it gets ignored. Then something changes. A new story emerges. And suddenly attention floods in. That attention is what drives the next phase. Because once people start connecting the dots, deficit, rising demand, constrained supply, and now concentrated accumulation, the perception of value begins to shift. And when perception shifts, price follows. Not instantly, but inevitably. Now let's address a critical point. Is China hoarding silver? That word gets used a lot, but the more accurate way to think about it is accumulation with intent. Countries accumulate resources for specific reasons: industrial security, supply chain resilience, strategic leverage, future demand expectations. It is rarely random, and it is almost never short-term. So if China is increasing its silver imports while restricting exports, it suggests a long-term view, a view that silver will remain critical, a view that securing supply now is more important than leaving it exposed to global markets. And that kind of positioning does not unwind quickly. Now here is where things get even more interesting. Because global markets are interconnected, if China absorbs more silver, other countries have to compete for what remains. That competition can show up in different ways: higher prices, more aggressive buying, increased volatility, and eventually potential supply stress in specific industries. This is how local policy decisions become global market drivers. And silver, because of its dual role as both an industrial and monetary asset, is particularly sensitive to this kind of shift. Now zoom out again, because this is not just about China. It is about the structure of the entire market, a market with rising demand, limited supply growth, and now increasing concentration of physical metal in key regions. That is not a balanced system. That is a system under pressure. And pressure in markets does not disappear. It builds, it shifts, and eventually it expresses itself through price. Now, does that mean silver goes straight up from here? No. Markets never move in straight lines. There will be pullbacks. There will be volatility. There will be moments where the narrative fades and attention shifts elsewhere. But the underlying conditions do not reset easily. Once supply is absorbed, it is absorbed. Once inventories tighten, they stay tight until something changes fundamentally. And right now, there is no clear sign that those fundamentals are reversing. If anything, they are becoming more pronounced. So what you are looking at here is not just a headline about imports. It is a signal about direction. A signal that one of the largest players in the global market is positioning aggressively. A signal that supply is becoming more controlled. And a signal that the balance between availability and demand is shifting. Those are the kinds of signals that tend to matter over time, not in a single day, not in a single week, but over months and years. And when markets finally adjust to those signals, the moves can be significant. Because by the time the story becomes obvious, the positioning is already done. That is the part most people miss. They wait for confirmation. They wait for headlines. They wait for certainty. But markets move ahead of certainty. They price in what is coming before it becomes obvious. And what is happening right now, record imports, export restrictions, tightening supply, looks a lot like the early stages of a shift that has not fully been priced in yet. So the real takeaway is this. China is not just buying silver. It is controlling access to it. And in a market that is already tight, that matters more than most people realize. Because control over supply is one of the most powerful forces in any commodity market. It changes behavior. It changes expectations, and eventually, it changes price.